Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure.
And I'm Guy Allard. We've got Valentine's Day coming up here in a couple of days. Victor, are you prepared?
No. Haven't done a thing. Not that I haven't been thinking about it, honey.
My wife wanted to go to Italy. I said, no, can't do that.
How about Greenville?
That's right.
No. Olympics are on. The market is getting more volatile than my ex-wives.
Going crazy?
It's gone nuts. Up and down, up and down. Some of the reasons. Got to tell them about some of the reasons.
Well, there's a lot of things, and we were talking earlier, kind of the problem with this 24/7 news cycle that we have, right? You can see what it's done to politics. You want to get away from the TV. Even though you're interested, you can tune in about once a week and get caught up just fine. Probably once a month, right?
Right.
So what they're doing with the downturn, now it's officially a correction, right? Because the market's down 10%, is they're coming up with, and the different pundits all have their own reason why the market is going down. I refer to it as the reason du jour, because there's so many of them. We thought we'd go through a few. Really, it looks like the market's probably just trying to seek a normality. I don't think you could find anyone last year, Victor, that didn't hedge the growth with saying that something is due, would you?
Yeah, until like the last probably 6 months.
You got 2 euphoric?
Yeah, the last 6 months. No, the economy's, and it's true. We've got one of the lowest unemployments ever. Economy's growing. We got the tax cut companies. All that stuff is true. But you can't go up 8, 9 years in a row and not have some kind of correction. It's never happened in history. The PE ratio, if you're going to go to the forward-looking PE, is double what it's supposed to be, even with the increased earnings. And the Shiller PE, which is many argue is the more accurate one,
right,
is double what it's supposed to be. And so there's always some kind of day of reckoning.
I would, and I heard a guy earlier this morning talk about it. I'm going to kind of steal his thought because I agreed with it so much. The economy is good. So the market is not crashing because we have a bad economy. If you remember back in 2007 or so, you could look out, the skies were blue, but on the horizon you could see a storm and you could see lightning and you could tell the kids, everyone, come on, let's get in the house, let's prepare, the storm is coming. Right now the sky is blue. So let's talk about some of the things that you're probably hearing. First one is ETFs, exchange traded funds. BlackRock is one that's mentioned because they manage $1.3 trillion worth of exchange traded funds. Victor, the difference between exchange-traded funds and mutual funds is?
Yeah, mutual funds always sell at 3 o'clock. The reason why even a program trader that sells mutual funds, remember back in the day, everybody had mutual funds, most 401ks. Some people do hold individual stocks, but it's less individuals, people with a little more money typically back in the day. Now, everybody owns ETFs. All those mutual funds can't cause an intraday panic. In other words, you're not going to see a market go down 500, up 300, down 2,000 because it sells at the close. The market's already closed, so they can't. In other words, all these sell orders, they see them after it's too late, right?
If you call it 10, 10:30, 11 in the morning and you want to get out of something, it settles after the market closes.
That's right. So with an ETF, which more and more people, all of our managed accounts are ETFs. ETFs can sell intraday. And so what the market sees is, oh my gosh, these computer programs just triggered $1 billion in sale orders. And so now we've seen an intraday crash which feeds on itself. Now the other public goes, oh my gosh, the market's down 500, get me out. Everybody starts looking at their 401ks, get me out. So it feeds on itself when you have intraday volatility like we have now. So it's a big difference between what it used to be and now. Some people say it's only computer trading. I think it's a combination of computer trading and the liquidity of the market now. Remember, ETFs are more liquid than mutual funds.
And it becomes self-fulfilling as long as we're talking about computer trading and all of that. Think about it. They've got parameters set. If the market goes down so much, automatically, boom, computers trade, they sell off. It gets to a certain point, they're back in again. So what's happening? We get a little bit of a panic. The ETFs come in, the markets go down. the computers say, oh, sell, so they sell. So the market goes down. It goes down to a point where they hit their buy spot, right? So all these computers and all this stuff, now they're buying, and it goes back up. People are selling, so then they got to sell. So it's kind of like a merry-go-round, or can be.
And what happens is some of them you'll see they're trading on moving averages. And when you're swinging 2,000 points a day, a lot of them, if they had a less volatile sector, they're going to be hitting those stops on either side.
And
buy stop, sell stop.
And just if you follow moving averages, we've gone past the 50-day, and now the concern is the 200-day. And if we get to the 200-day, then, could be Katie bar the door. But don't panic again. The economy is good.
But remember, even with a good economy, how far can the market go down? I don't think it will because the economy is stronger than normal. I've been advocating probably a 20, 30% correction or bear market, whatever, just to make the numbers closer to normal. But who knows? Because it went up, 5 or 6% in January, I think, right?
Oh, yeah.
And it's knocked that out. It's knocked out December. But even with that, I think year over year, you've made still 15, 18% over the last 12 months.
All right.
So it's not bad.
We've talked about ETFs. We've talked about computer trading, another thing. And Victor and I, we did a show on this years ago, like 3-4 years, about how high the margins are. And when people get margin to this extent, it's kind of like a writing on the wall that the market is going to correct. Bull markets love margins. Why? Because you're putting more money, more fuel.
Let's explain what a margin is.
Yeah, go for it.
What you have is you can buy stock. Let's say you've got $100,000 in stock. In cash. You can actually buy $200,000 in stocks. It's called a margin. You put them on margin, which basically you're borrowing from the brokerage firm
and paying a good interest rate for the borrowed money.
It's not going to be 1% interest rate, but it's not horrible either.
No.
But it allows you to buy $200,000. What's the issue with that is when the market's going up, you make twice as much money per dollar. So if the market makes 10%, you make 20.
So bulls like margins.
That's right. Now what if it does the opposite?
Bears don't like margins.
So if it loses 10%, you lost 20.
That's
because you only have 50% of the money in there.
And the first thing that usually liquidates because of that is the margins. And quite frankly, we haven't seen that happen yet.
Right. What was that? The show that just came out like last year or year before?
The Big Short.
Yes, The Big Short.
The Big Short.
Oh, you got a $500 million margin call. That's what it is.
I know. Just maintaining those is painful.
What you do is if it goes down 20%. You don't have enough margin in there, right? 20, 30%. So you have to put up more money than you had initially. Say you had that 100,000, you were buying 200,000 of stocks. The dang thing drops, you got to maintain your margin back up to levels. And so you got to put a bunch of money more in just to maintain it. And if it keeps going down, you have to continue doing that or they will sell your position out and you'll realize the entire loss quickly. And so all of those, you've got computer trading. You've got ETFs dominating the market now. And you've also got this kind of thing with margins. What was the margin level last time you checked?
I haven't checked in a while. I hate to admit.
But it's supposed to be the highest in history. Or something.
Yeah, absolutely. And let's throw out another one. You're hearing a lot of things, but I'll remind you, or we remind ourselves a lot of times, if you keep your allocations in line, if you have a plan, if you have enough liquidity, if you have enough income for retirement, and you've got the inflation hedge stock market stuff based on your age, all of this is just fun to talk about and speculate, we're hoping, for everybody. Right. All right, what about the QE, quantitative easing? What about those bonds when they hit the market? What's that supposed to do?
What you do, bonds are just a factor of supply and demand. People don't realize that. It's interest rates and supply and demand. Like if I've got an old bond paying 2% and a new bond pays 3%, there's more demand on bonds now, but not on my bond, right?
That's right.
My bond has to go down. But there's more demand on bonds when interest rates go up. Because people, like I said, I don't want to lock up a 10-year 2%, maybe 4%, maybe it starts coming in there. But also what it does, that's I think the most scary, is our deficit, the amount of bonds that we have out as a country right now are just, I can't think of ginormous is the only non-word I can use.
And they're referring to it as a debt bomb right now.
Every 1% increase in interest rates, blows out the budget deficit, everything.
What happened to austerity? All of a sudden, people don't care about that anymore and being fiscally conservative and paying down the bills. Also, We had Mnuchin, I believe it was, earlier in the week or beginning or end of last week talking about the weak dollar, which it's been talked about, discussed that perhaps that started things.
Yeah. I don't know about, like I said, it depends on if you're exporting or importing, whether you want the dollar strong or weak. Right?
Absolutely.
So I just don't know, because I think it needs a correction. Corrections are healthy. Remember, the reason why they always raise interest rates, why we had that big inflation back in the late 70s, early 80s, it's supposed to cool off an overheated economy.
Right.
On purpose. And it does. Trust me, you start charging 15% for mortgages, people ain't buying houses. That's just the way it is. So it'll cool it off. We're so used to a low interest rate environment. We've had it so long. It would destroy. Back then, it slowed it down, really.
Right.
Back in when I was a kid, and all, it slowed it down. It would destroy the economy if you got interest rates too high. And that's why, in my opinion, my humble opinion, the government will never raise interest rates crazy like that again. Now, will they get them higher than they are now? Yes. Fed funds rate is still, 0.5% or 0.25%?
And to seek normality, it should be higher, don't you think?
Right. But you'll never get the really high numbers because, like I said, remember, what are 70-something% of our economy? Consumerism, what we're buying and selling in the United States. And that's what capitalism is.
And people are still spending like crazy right now.
But this should we've been talking about this for a long time on the radio. It's difficult. If you listen to a lot of radio shows, television shows, whatever, they've been warning you of impending doom for 3 years? Because the market was overvalued 3 years ago, and it continues to go up. And honest, I see both sides. When the numbers never lie, and eventually it's going to come to play. But people get tired of hearing it. Well, that guy said, I'm glad I didn't listen to that guy, right? Or that girl, because the dang thing kept going up. But there's other factors that can make the market go up. Like when Trump got elected, the thought of, I'm talking about just not political, just the stock market. They're thinking, well,
optimistic.
That's right. What does the stock market consist of? Companies, right?
Right.
And the biggest thing they ran on is lowering the corporate tax. What does lowering the corporate tax do for companies? It makes them more profitable.
Absolutely.
So therefore, the stock market goes up. Now, going up 20% in a year. And remember, the tax reform is
when it was already crazy overpriced.
Right. It might be too much, but there's so many factors. If you're prepared, none of this stuff. I haven't panicked. My clients haven't panicked because they've got an income. They've got their bucket strategy in place. They got their income thing. They've got their inflation hedge. They've got their reserve accounts. I was just talking to a client the other day, or a potential client, I'm sorry, and they were saying, I think I'm pretty handled here. I'm pretty well diversified. You look at this portfolio, it's not well diversified. It's basically all in stocks.
Yeah.
I go,
but it's diversified in stocks.
That's right.
And so it's diversified, right?
So it's got several ETFs and mutual
Right.
funds. I go, okay, you got a lot of stocks there, but what if the whole stock market goes down? Well, no, I think I'm fine long term because I've done a retirement plan from Fidelity. And I go, my thoughts on Fidelity retirement. They're not real. Because what they do is they'll give you some average market return. The average market, bonds have averaged 7% for like 100 years. All right? Stock market's averaged 10% for 100 years. And so they're saying if you average this, you're fine. Well, we've actually received 5% return on the stock market the last 18 years and about 3% on bonds, maybe 3 to 4.
And to put it in perspective, if I can, if you retired 10 years ago and you counted on the 7% bond return on your safe money, so $70,000 for every million that you've got saved, you were only getting $30,000 for every million.
But they don't show that in the retirement readiness calculator they're doing. All they're showing you is average market. Now they say below average market. But we made half of what the average market made. They might be using an algorithm that says 75% is below market because it is below market, right?
Right.
But they're discounting everything that's happened this century. And that's why all those things don't matter. You've got to have an overall plan that really looks. Remember, we do this stuff every day for 30 years each without a single complaint between us. And if you'd like it, like I said, for us to look at your portfolio, make sure you're protected, 972-715-2424. Again, 972-715-2424. We can always go to our website, ilovemyretirement.com.
And think about it now. How do you prepare yourself? What do things look like going forward? And again, at the risk of being redundant, if you've got a plan, if you've got your liquidity, you've got your income taken care of, you've got your inflation hedge taken care of, we can have fun with this and we can discuss it. So let's look at what's competing with the market now, right? When the dust settles, the Fed's told us we're going to have a rate hike. 3, I've heard possibly 4 rate hikes, probably a quarter of a point each, somewhere in there, which is okay, right? We're looking for normality. We're looking for a normal level. But now, instead of 2%, I can get 3.5 on a 10-year, maybe. It's competitive with the market. Everyone had their money in the market for years now. It's been going up. It's euphoric. They were seeking yield. The only way they could make their retirement work was to have all their money in the market. Now we've got something that's competitive with it. We talked in the last 2 podcasts about the Ibbotson, if you prefer, report, emeritus professor from Yale, that's talking about fixed annuities and how they are actually a better replacement in this rising interest rate environment for your safe deal. But anyway, the point was, and I digressed, is bonds are now going to be competitive. They're going to be competing for your money instead of the market.
One thing is, even to simplify it even further, if CDs are paying 5%, and we know the stock market's only made 5%, went down twice in the last 18 years, a lot of people are going to be just saying, let me get off this roller coaster and I'm just going to buy some CDs. That's just normal. And so, but right now,
with no risk.
Yeah, think of all the 401ks. When I was younger, got in this business in the 80s, they just started coming out with 401ks. Nobody had them. Every once in a while you had them because you still had pensions. And then we got away from the pensions into the 401ks. Now everybody's having. So the average American has stocks when they did not before. The turn of the century's stocks were only for the rich people.
Right.
Back in all the way to probably in the 50s maybe.
The ticker tape deal.
That's right. They were only for wealthier people. Now every person, you can, you'll see a receptionist making $30,000 a year that has a pretty good size, 401k. And so everybody has it. So all that emotion that goes into it, because I'm telling you, you work hard for your money. And watching it go down is a lot more difficult. I have so many people in the markets going up telling me I'm pretty aggressive. No, I can take it. I've got it diversified around. And if it goes down, I've already got that factored in emotionally. And they're the first ones to sell when the thing goes south a little bit. Because what happens is they want really good returns. They really don't want risk. And that's one of the questions we ask people when we're doing our fiduciary duty. I say, okay, let me ask you this. What do you expect from your financial advisor besides return? We'll go over the other stuff for, the planning purposes, their insurance needs, all that kind of stuff's different.
I'm looking for 10% return.
That's right. I want a 10, 15. They go, I've been making, I hear it all the time. Well, I've been making 45% a year, something crazy. And I expect this out of you, but I'm just a little tired of handling it. All right. So you expect 10%. All right, what's the worst thing that can happen? Well, losing money. I wouldn't hire you to lose money. So wait a minute. You want the greatest returns in the world, but the worst thing that can happen is losing money. You're not a risk tolerant at all. You actually just want better returns, but you don't want to take the risk. You have to, if you're going to take the gains, you got to have to take the losses. But if you get just, like I said, to repeat one more time, if you have your plan in place, that stuff doesn't matter. You've already factored in the stuff because you can't go broke, number one. Your monthly income in retirement is more than your bills. And you've got all these things covered. So you don't have to sell into
a weak market.
That's right.
But make no mistake, we all want the stock part of our portfolio, even when the income is taken care of, right? And we've got enough liquidity, which sometimes people overlook that, right? They just do the stocks. But if you got the liquidity, you've got your income taken care of, we still want the stocks to do good, right? But you're not as concerned about it.
Well, the only thing I hope this does for a lot of listeners out there and a lot of everybody is it's so easy to get complacent. I'm telling you what, 2 months ago, somebody says, maybe we need to look at your portfolio. I go, sorry, buddy. I just made 25% in a year. I think it's fine for now.
Yeah.
And hopefully this kind of volatility.
I think I'm going to get one more year out of it.
My ex-wife's volatility showed up, and it finally got me to action, right?
When it gets painful enough, we will act. It's an old pleasure-pain deal. We'll do more to avoid pain than gain pleasure.
But that's what I hope this does, is this market is just, it just lets you know that, hey, the market can go down. And
for no reason sometimes it seems like, right?
Well,
the economy is good.
Well, think about all the news that came out this week. The market started going down, last Friday?
Yes.
And we're recording the show. Hopefully the market doesn't do something crazy Friday afternoon because it's Friday morning right now. We understand this is being sent for Saturday. But it started doing all this stuff, and we're looking at it. They got the lowest unemployment rate ever or something in 20 years, 50 years, whatever. All these earnings are higher.
Wages are going up.
So it goes straight down. Remember a few months ago, you got a bunch of negative reports. Then goes straight up. There is no rhyme or reason. Long term, though, I'm telling you right now, stocks are driven by earnings. You look at everybody goes, well, the stock market, you look at the Ibbotson charts we talked about, $1 worth $5,500.
Right.
Now, the PE ratio is higher than normal, but not that much. It's still, there are 2,500 to 5,000 more times earnings than they had back then. And so that's what stocks are different than a lot of other things. When you're buying options or you're buying things, stocks, you're buying ownership. And somebody was saying that the Bitcoin or whatever. I go, Bitcoin is a form of payment. What are you buying? You're just like buying dollars, but a different kind, right? But you're not buying ownership in things because the Bitcoin can just go to nothing, right?
Right.
Oh, nobody's going to accept that crap. It's gone. But ownership in a company, unless the company goes under whatever, it's still going to do it. And if their earnings keep increasing, that value over time can increase. It doesn't always happen like that. Sometimes you see earnings go up, the dang thing goes down. Sometimes you'll see earnings go up, but the analyst thought it should go up a little tick higher, so then it goes down.
It still goes down, that's right.
So there's no rhyme or reason, but long term, you get more earnings into a company, they make more money, the value of the stock should go up. It makes sense, right? It's called the fundamentals. Fundamentals always come out. The technicals can be crazy one way or the other, and I think they're influenced right now by the computer trading, the more reliance on ETFs than before. Do you realize half of the ETFs in America are based on other ETFs?
It's crazy.
It's ETFs on ETFs. Now, how could an ETF supposed to buy a bunch of stocks, right? S&P 500 buys the S&P 500 stocks. They could have 5, 10 offshoots off that one thing. So it's kind of weird. If you got an ETF on an ETF on an ETF, so in other words, you leverage this same exact stock 5, 10, 100 times.
That's right.
That's what can cause a lot of damage if things get crazy or volatile. Lots of damage.
And I'd revisit bonds a little bit, or not bonds, I'm sorry, the debt bomb and our nation's debt. If you look into that a little deeper, and it's one of the things that concerns me, who's going to buy our debt when we have so much where it becomes almost impossible to pay it back? And what happens at that point? If they do buy it, they charge us more for it. And just the interest cost on carrying it. I mean, no one seems to be doing anything about that in Washington.
What was a couple of years ago? What were Chicago bonds paying?
Oh, yeah, lots.
8%?
Yeah.
What were Puerto Rico bonds?
I don't remember.
So is that a buying opportunity for those bonds? No. It's because nobody would touch that crap, period, because the economy's so bad. But like I said, if our economy's not bad, and I'm one of those proponents, I'm a veteran, it's pro-America all day long. They're not going to change the global currency. Even if they did, it didn't affect England when they took it off the pound sterling, 100 years ago or 50 years ago.
It's sure beneficial that we are the reserve currency.
Right. So there's no economy bigger than us. There's no currency bigger than the dollar. So I'm okay with all those different things, but the market can't go up 8, 9 years in a row and not go down. Think about it. In the 2000s, what happened? The only thing you had is pretty much it went up for the entire 2000s, right? The 90s, I'm sorry. Except for 94 and 90, which is kind of an even years, maybe gone down slightly. Then it crashed, right? Then it went up from 2002 all the way to 2007. Pretty drastic move up.
Right.
And then it crashed 50% again. Now it's gone up from 2009 all the way till now, right? 2018.
Yeah,
that's
crazy.
A long one, right?
Very long.
But the economy is different. Back in 2007, remember they were loaning like crazy. I was buying a lake house in Cedar Creek Lake. And I I actually called a loan person, right? Already had a house in Plano. And they said, yeah, you want it? Okay, well, we'll give you a couple million. I go, well, I didn't want to spend a couple million on a lake house, but I go, well, you didn't ask much about me. Well, you're that guy on the radio, right? Yep, okay. Yeah, no problem. Signature loan. And I go, well, don't you need my income and all that stuff? You just sign that you make something right there.
Very loose monetary policy.
And the reserves at the banks and at corporations were the lowest in history. How much actual cash they had. What has happened since then? Corporations have more cash than they've ever had in history. Banks have more reserves than they ever had in history in cash. And so they can absorb a lot more than they could back then. They weren't selling these derivatives, pawning them off, those auction rate securities. They're basically mortgages, and they're selling, but as soon as they quit buying the things, they're done.
Well, I remember
actually muni bonds.
The whole deal was the rating groups were in on it. They were giving high yield or junk bonds high ratings. They were packaging them. They were selling them to municipalities. I mean, it was a whole thing.
Oh, yeah. Remember, I had clients at the time. They're going, well, I've got a tax-free money market. And I go, there's no such thing. And he goes, you don't know what you're talking about. There's a tax-free money market. J.P. Morgan's selling it. And my buddies over at Merrill, and they got it too. And I'm like, there's no such thing as a tax-free money market. The only thing that's tax-free would be a municipal bond, right? Yeah. Or loans from a life insurance policy.
You get tax deferred.
So what they were doing, they were bundling these municipal bonds, and they could auction them they held an auction every week. So they called them money markets. And that's why all of the major firms, this is why I don't understand why people are scared to go to small firms. These major firms, every one of them that you've ever heard of, has paid billions of dollars in fines and fees for screwing people like that, telling them it's a tax-free money market when there's no such thing. Speaking of no such thing, I had a client tell me the other day, he said, yeah, that program looks pretty good, but I put it all in a 5.3% CD. And I was like, 5.3% CD, huh? Oh, yeah. I got it in the paper. I was like, that doesn't exist, right?
What was it?
They'll have it. It says 5.3% CD. And I go,
is that the aggregate?
They go, well, obviously you don't know what you're talking about. This other guy sold it to me, and it's FDIC insured. I go, well, let me tell you what it is. They're buying a 1 or 2% CD. That's what's FDIC insured. They're doing it for small amounts of money, like 10 grand or whatever, right? They're going to throw in that extra interest. So let's say you're getting it for 2, they got to put in another 3%, right? So they're going to take 3% of 10,000, which is $30, add it to your interest, so you're getting 5.3. And you're like, well, even though they're not disclosing all that, I'm still getting my 5.3, right? That is true. The problem is you've just opened the door to the most high-pressure sales force you've ever heard of. Because remember, that's a loss leader. They spent that money for your lead. They're going to be all over you. And sometimes it's easy. It comes in a little differently. It's not. They'll say, well, we're just going to give you a free, since we've got you that CD, we're going to give you a free portfolio review. And these are not financial advisors. Like, we're registered investment advisors. We're legal fiduciaries, right? We can't incentivize you to do business with us. Who can? Life insurance agents, annuity salesmen. And you're gonna see an avalanche of annuity salesmen and life insurance coming after you. And they're going to have, like I said, it'll be under the guise of like a portfolio review or a retirement readiness test, whatever. But you've opened the door for them to sell you and sell you and sell you by getting $30 on a $10,000 CD.
And I know they're your axis of evil being the banks, but I know we're running out of time. But Wells Fargo, boy, did they get their hands slapped, huh? The penalties and the fines and the growth and the firing.
There's almost every major firm has paid a huge amount.
This is this last week, right?
That's why I'm more of a fan of like Fidelity. I haven't seen that much with them. It's been less. The other ones have made huge deals. But just remember, there's no such thing as a 5.3% CD. It's just somebody paying you a little extra to get you to market so they can market to you, and you just gave them permission to high pressure sales you to death every time because they can't. There's no such thing as a 5% CD in America right now without somebody kicking in something.
That's right.
Right? Because the bank is not, and the FDIC is not going to do theirs because they'll probably just give it to you cash. So, well, that's our show, folks. Don't worry. The market will be okay. If you have any financial questions or you'd like to take advantage of our no cost, no obligation retirement plan, stress test, Social Security optimizer, our number is 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. I'm Victor McClure. For Guy Allert, we always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.